Hello. Corporate treasurers, like everyone else, have been preoccupied by the COVID-19 crisis. But for the next 45 minutes, we will be considering the question, how prepared are you for IBOR transition? Welcome to this Association of Corporate Treasurers webinar in conjunction with Lloyds Bank. I'm James Winterton, an Associate Director for Policy and Technical at the ACT. Interbank offered rates, or IBORs, are undergoing transition, affecting many contracts, from complex derivatives and syndicated loans through to the interest rate charged on late payments. Today's webinar is focused on the interest rate benchmark Libor, which is expected to cease after end 2021. All market participants must transition to alternative reference rates before then. Until end 2021, Libor is based on submissions provided by a panel of banks intended to reflect the interest rate at which banks could borrow money on unsecured terms in wholesale markets. However, the absence of active underlying markets raised questions about the sustainability of Libor. Currently, Libor is produced in 7 tenors, such as 3 months and 12 months, and across 5 currencies. Today's speakers will focus principally on sterling Libor transition in the corporate debt markets, but the transition effort applies to all IBORs. But before I introduce our panel of experts, a little bit of housekeeping. You'll see a Q&A button on your screen that allows you to submit questions to the panel. We won't mention your name, and we'll try to tackle the questions as we go along, so please don't wait until the end to send them in. We will also be conducting a couple of audience polls during the webinar. Again, these are anonymous, so please do take part when invited. This session is being recorded, and the slides should be available on the ACT website by the end of tomorrow. Turning now to our speakers, our first speaker from Lloyds Bank has over 30 years Treasury experience, and he is a member of the UK Working Group on Sterling Risk-Free Reference Rates. I'm delighted to introduce the Group IBOR Transition Director of Lloyds Bank, Ian Fox. Hello, Ian.
Hi, James. Thank you.
Hi.
Yeah.
And joining Ian from Lloyds Bank, where he leads Lloyds' commercial banking lending product team, specifically for the IBOR transition, is Philip Harvey, head of IBOR transition, lending and transaction banking products. Hello, Phil.
Hi, James. Good afternoon, everyone.
Hi, thanks, Phil. And our final speaker is Sean Kennedy, Group Treasurer at Associated British Ports, where he heads the group's treasury and insurance functions. Sean is also a member of the UK Working Group on Sterling Risk-Free Reference Rates. And of course, he's an ACT member. Hello, Sean.
Afternoon, everyone.
So we'll kick off with a presentation by Ian, who will bring us up to date on some of the recent developments in the market for Libor transition and the implications for buy-side clients. Next, Phil will highlight some of the lending products available to support the transition, and then we'll turn to Sean for a corporate treasurer's perspective on preparing for Libor transition. But I'll now hand over to Ian. Ian, over to you.
Thanks, James. If you can put on my first slide, so we're going to start with a quick view of what's been the impact of COVID-19 on the market and therefore on IBOR transition. So at the start of the kind of realized impact on the market, we saw market disruption. And one of the first things we saw was central banks globally cutting interest rates. And if you look at that top right chart, the blue and the red lines are base rate and SONIA. So fairly flat through the first couple of months of the year. And then we saw cuts from 75 basis points to 25 and then again to 10 basis points. So this was the authorities reacting, wanting to impact the economy through monetary policy. The green line is 3-month Libor. Whilst it started to come down initially, it has widened in terms of the spread that we saw previously between Libor and base rate and Libor and SONIA. So the authorities are concerned that monetary policy is not being properly affected through the transmission mechanism of Libor. In fact, it's doing the reverse. So the relative cost of borrowing versus Libor rather than versus SONIA was more expensive, which was not what was intended. We also saw reduced market activity. So the bottom chart shows the proportion of Libor quotes that are based on actual submissions from banks compared to effectively interpolated views. And the actual submissions is the blue piece at the bottom, which has been minimal all the way through, but reduced again during the market disruption caused by COVID. Thirdly, from the authorities' perspective, there was an intention to have a broader corporate communication exercise kicking off in March. That was cancelled for obvious reasons and has been delayed. It's intended to restart hopefully in Q3. But we've seen a delay to that wider education and communication piece to the broader corporate market around the expected demise of Libor at the end of 2021 and what people need to do to prepare for that. There's been continued adoption of SONIA in the wholesale markets. Work has been going on within banks to do what we can behind the scenes. Clearly, there has been impact in terms of resources within banks have been diverted to cope with customer demands, whether that's C-bills or CL bill loans, payment holidays, overdraft, cash flow queries, that kind of stuff. But other resources, particularly within large banks, have carried on with the preparations. So things like development of products, development of internal systems, changes to processes within banks has been going on through this period to ensure that we are getting as ready as we can for the end of 2021. Within clients, then clearly there's been the same impact, and if not greater, that resources that were looking at IBOR transition are now looking at COVID-related impacts, looking at business survival, to be honest. And that is entirely understandable, and it's understood by both the banks that want to engage with those customers and by the authorities themselves. It's a natural reaction to what has happened. So those engagement plans have been delayed. If we go on to the next slide, James, please. So what has been the response of the authorities? So we've seen a couple of statements issued by the UK working group, one on the 25th of March, one on the 29th of April. They have both reiterated there is no change to that end of 2021 deadline. From that perspective, if anything, that market reaction I highlighted has strengthened the authorities' view that Libor is not working as it would be intended to do. And it has strengthened the view that Libor should be replaced as soon as possible. So that end of 2021 date is as solid as it was before the crisis came along. There has been some relaxation of some of the interim milestones that the working group has published in the past. So particularly the Q3 2020 date, which previously was saying there should be a cessation of sterling Libor cash products. That has been softened to say you can still write Libor products, but they must have any new products written against Libor from the end of Q3 must have capability to be mandatorily transitioned. And we've seen a number of examples of loans that have been written recently that are initially setting against Libor, but they have a fixed date in the future when they will fix against either SONIA or SOFR at predetermined spreads. And I think that will become a growing feature of the loan market as we go forward over the next few months. Initially, the regulators suspended regulatory oversight of bank transition programs. That has since been reinstated, so there was a 3-month window. We as large banks are required to submit formal detailed data templates quarterly to the authorities. They can see the pace of our transition and what our Libor exposures are doing. And also provide a qualitative update on our transition plans and any issues that we're facing. And that is, as I say, that has now restarted again. What the authorities did...
Sorry, and for interrupting, but just on, because these deadlines, there's quite a lot of them for treasurers on the call to take in. And you mentioned the Q3 deadline being extended. So just for clarity, my understanding, which maybe you can confirm, is that lenders have to be ready by the end of Q3 2020 in order to lend. And also we have to have fallback places anticipating the cessation of Libor. But borrowers do not have to be borrowing against alternative reference rates until Q1 2021. Is that a fair summary?
So from the end of Q3, as I say, any new Libor loans have to have this mandatory transition language in. Lenders must be in a position to offer alternative rates. So that doesn't have to be SONIA, for example. It could be bank rate, it could be fixed rate. But you don't have to take a Libor loan from the end of Q3. But you're right, after Q1 next year, that is the end of new Libor-linked lending. So any new loan from then will be an alternative rate, which could be bank rate, could be term SONIA if we have that by then, could be SONIA, could be fixed rate.
Yeah, that's a very helpful clarification. Thanks.
Okay. The authorities also published areas where they wanted the market to continue work during the COVID crisis, and those are the areas I've already referenced. So building consensus on some of the industry standards that we need to have bottomed out. I'm sure we'll get onto loan conventions during the course of this broadcast. That work is ongoing. The work on tough legacy was something that the authorities highlighted would continue. We saw the very helpful announcement from the authorities last week that legislation will be brought forward to give the FCA power to deal with the tough legacy problem. So that is great progress. And then plans to intensify customer communications when it's right to do that. And we're looking at towards the end of Q3 will probably be the right time, we hope, if there's not a re-emergence of COVID for when we think we can re-engage with customers again. Take us to the next slide, please, James. So in terms of what's going on in the loan market at the moment in terms of conventions, so a term rate paper, a term SONIA paper was produced by the working group back in January, looking at cash markets, not derivatives. And that concluded that broadly 90% by value of cash products in the UK could and should use daily compounded SONIA, leaving a rump of around about 10% by value of products that might need to look at an alternative rate. And that alternative rate, as I say, could be term SONIA, could be fixed rate, could be bank rate. So for the vast majority of the market, the expectation is you will need to build a capability to deal with daily compounded SONIA. It will align with the way that derivatives markets are working and the way that bonds markets are working. So it does make sense. There are live conversations going on at the moment in terms of the detailed calculation convention to be used. I won't get into that in too much detail, but those conversations are involving UK lenders, UK authorities, but also the US, because there's a preference to have international alignment where we can. We may have to make some compromises to get there, but it would be helpful if we're using the same convention on both sides of the pond. Use of an index. An index is something that we will have to come back to. We need to get the convention sorted first, and then we need to work out whether an index is applicable for the conventions that the market chooses to use. And then there are separate questions around who might publish that index and who might use it. But we do understand that where an index can simplify the calculation, then it is beneficial. There are a lot of system implications. The nature of the convention that is chosen in the loan markets does drive the system build for lenders and their loan platforms, and obviously for borrowers and their platforms as well. So that is a dependency and why we're working on it quickly. The expectation is we will have agreement on both sides of the pond on terms of those conventions by the end of this month, by the end of July. I've talked about pre-agreed conversion terms. They will become more prevalent as we move closer into the end of Q3. And then the alternative rates I've already talked about if daily compounded SONIA is not applicable. Next slide, please, James. So what does all that mean in practice? Well, the IBOR transition date has not changed. It is still end of 2021. That is when the working assumption has to be that Libor could and is likely to cease. And we saw another announcement from the FCA in the last few days that it may well be that an announcement comes by the end of this year, end of 2020, advising that Libor will cease at the end of 2021. We need to see what that will look like, but that is the threat. Any delays caused by the impact of COVID-19 must be caught up. So we have to get this all done by the end of 2021. We've seen the use of SONIA derivatives increase. That's good, building liquidity in that market. In the bond market, the transition to the use of SONIA is largely complete. There are very, very few Liable bonds issued now. The majority are issued against SONIA. Loan markets is where we need to accelerate. So we need to get these conventions locked down. We need to get documentation sorted out, whether that's as a standard SONIA loan or with that mandatory transition language agreed. The legacy contract transition, as I mentioned, needs to start in earnest before the end of this year. So probably end of Q3 into Q4. Hopefully communication efforts will restart, and that's when corporates need to think about re-engaging with their banks and the IBOR transition. But we acknowledge the timeline for transition is getting shorter. Where we thought we might have 18, 19, 20 months to do that legacy transition, we're now going to be left with not much over 12. So we're going to have to look for simpler approaches to transition. So I think a line-by-line renegotiation of every clause in the contract is not really feasible. We need to look at simpler methodologies to transition contracts from Libor to risk-free rates. And the ultimate risk is that for those that haven't got themselves ready in time, they may find that their borrowing options, certainly into next year, will be limited because some of the rates that they've seen in the past will not be available to them, particularly Libor won't be available after Q1 next year. So James, I think you've got a polling question for us now.
Indeed. So Ian, that's been fabulous. And I know that next you're planning to talk about the action plan for treasurers, but treasurers have a lot on their plates at the moment. So before we get to the action plan, let's have a look at our first audience poll. As I said, this is anonymous, but it's asking you please to select your top 2 current priorities. Please only select 2 from the list that is shown here. So you can click on 2 of those boxes and then press submit in the bottom right-hand corner. And just while we're waiting for the audience to do that, Ian, you mentioned the sort of calculation methodologies, observation shift, and so forth, which is all quite technical. And many mid-tier treasurers that we talk to are waiting to know what will be the new market conventions that will be incorporated into their treasury management systems. So do borrowers really need to get to grips with all of the technical differences between alternative compounding methodologies? Surely they just want to know the new standard. Do you have any comments, Ian, on that, please?
Yeah, I think that's fair. I think it's for those at the sharp end, the lending banks and the authorities to sort out what the convention is. And it's probably not a good use of time for the majority of corporates to try and understand the various differences at the moment. We will determine what is going to be the standard going forward. There will be the capability for lenders to look at alternative versions of that if they want to. And if people do want to simplify, then as I've said, we will have bank rate and fixed rate loans as an option. But it is very likely that in the daily compounded SONIA market, one convention will be the dominant feature, which will probably align with how derivatives are calculated and how bonds are calculated so that we can have effective hedging across those products.
Thank you. And so I'll have a look at the poll results now. And perhaps not surprisingly, mitigating COVID-19 comes out as people's top priority, as I think we would have expected. Interesting that business as usual, which category includes anything else that wasn't listed as an option, comes in a second, and then followed by Libor and Brexit. So quite a lot of issues really fighting for treasurers' attention at the moment. So in that context, Ian, perhaps you'd like to lay out what you see as an action plan for clients.
Yeah, and bearing in mind the message at the start from the authorities is that it is very likely that Liable will cease at the end of 2021. So people need to start making plans now for that eventuality and what they're going to do. So in terms of what do people need to do? Well, first of all is review, and if you haven't got them already, create transition plans, bearing in mind that the time is slipping away. That does require you to understand what your existing Libor exposures are. So what contracts do you have today that has a Libor exposure, and understand what your documentation says about if Libor isn't in existence anymore. Some contracts will have effective fallback language in them, some won't. So you really need to understand your individual contract to know what it is. Understand the new rates and how they're different from Libor. The key difference between Libor and any risk-free rate is Libor is a term rate, so it's 3-month Libor, forward-looking 3-month rate. SONIA and all the other risk-free rates are overnight rates. They behave very differently. The way the interest is calculated is different. So in SONIA land, it's daily compounded in arrears. So you don't know what your interest payment is until the end of the 3-month period, rather than upfront, as with a 3-month Libor loan today. So that will require different calculations, different processes to be in place. From your contract analysis, determine which rates are most appropriate for you. So are you going to be able to deal with daily compounded backward-looking SONIA? Do you have the system capability to do that? There will be some use cases where a term SONIA rate may be applicable. They are very limited, but it's worth understanding what the applicability of that rate is, and that document from the working group would be a useful reference point for that. And then understand what system and process changes you need to make to get yourself in a position by the end of next year to accommodate this change. Transition needs to happen in a timely fashion. There's no point leaving it till December next year and then running out of time. So I think early engagement with your lender and your system providers is the thing to do. And contacting your lender certainly before the end of this year to have that conversation around what are your exposures, what are their options, what are their timelines for transition, and then working out what a transition timeline looks like for you. And for those that think they need it, then seeking independent financial advice would be a sensible thing to do.
So, Phil, that's been brilliant. Thank you very much. Sorry, Ian, that's been brilliant. And can I turn now to Phil? So, Phil, if you could please tell us a bit more about how Lloyds is preparing for the transition and also help our understanding of the new lending products available for treasurers.
Sure. Thank you very much. And hopefully I can just sort of seamlessly follow Ian there. I think Ian's already mentioned some of the different options available, but really to just say that these options are not going to be uniform, available to all clients in all markets. I think obviously compounded SONIA, as Ian mentions, that is the recommended alternative to sterling Libor, and that's where we see the majority of products, loan products using that benchmark. Base rate, I think the slides might have moved on, but base rate is obviously an alternative. It's long been used in the smaller ends of the market, and I think we may find that is used a bit more widely going forward. It exhibits some of the same conventions of SONIA in that it effectively is a daily rate, and therefore you're not likely to see that term element with base rates. It's also one where it's likely to be shorter interest periods only, so it probably won't have some of the conventions such as lag or compounding, but may be only available for 1 month interest periods. Fixed rates, again, not a new approach to loans. Again, typically used at the smaller end or some mid-sized tiers and sectors such as social housing or education or maybe the real estate markets, typically for 3 years or longer. Obviously, that's a good way to get interest rate certainty if that's important to you as a borrower. And then term SONIA, as Ian said, it's not anticipated to be widely used. As of this point in time, the rates are not available. We're expecting 4 different administrators to be publishing rates in the very near future, but they will just be beta or test versions for at least the next 6 months. So there's more of a watching brief on term SONIA, and as I say, not widely available when it does arrive. So those are the choices available. I think it's worth just highlighting again some of the key differences between Libor and compounded SONIA. Obviously, that's where we expect most of loan products to exist. I think there's really 3 things to understand, first of all, with compounded SONIA, and understanding these, everything else kind of follows suit. So the first thing is that SONIA is a daily rate. So in that sense, it doesn't exhibit that term feature that Liable does, with obviously 1, 3 month and 6 month being the normal term periods that Liable's used for. And so that obviously is why you have a compounding methodology to deal with that term nature versus the daily rate. Secondly, SONIA is an overnight rate. So it means that today's rate you will not know until tomorrow, and yesterday's rate you would not have known until today. So that is why you go from the concept of knowing your rate at the start of an interest period to knowing your interest rate much further towards the end. But is also why the 5-day lag has been introduced, so that if you didn't have the 5-day lag, you would only know your interest payment amount on the day that you have to make it. So the 5-day lag is there to allow borrowers some time to understand how much they need to pay in those last few days of the interest periods. And then the last point why risk-free rates are different to Libor and term rates is that risk-free rates, exactly as they say, are risk-free or nearly risk-free, which means they don't include a term or credit premium that Libor includes. So essentially that means that there is an economic difference between a SONIA or a compounded SONIA rate and Libor, and that economic difference needs to be reflected, which leads on to discussions that some of you may have had around adjustment spreads or credit adjustment spreads or reference rate adjustment spreads or a variety of other different terminologies. So those 3 core principles then kind of define all the other differences, and also some of the things you'll come into when you start to discuss documentation. So just a little bit more on adjustment spreads. I think there's a lot of conversation going on. There's talk of adjustment spreads for new products, for products that are being transitioned, products that are being refinanced. In essence, there's two main methodologies that get discussed to define what a credit adjustment spread looks like. One of those is a 5-year historic median approach. So that is a relatively simple approach. It looks at past data and identifies what the differences between a compounded SONIA and a Libor rate have typically been. The alternative approach is a more technical approach, which is using the forward or swap markets. It looks at the future expected differences between SONIA and Libor rates. And based on those future expected differences, it comes back to a current value. Now, those two methodologies, unsurprisingly, don't always come back with the same rate. And therefore, it's an important consideration to have with your lenders as to how that credit adjustment spread is going to be defined so that you can work with them to understand it. What I would say is that at the moment, and it was slightly different during the months of March and April in the height of the coronavirus impact, and it actually links us right back to Ian's first chart, the difference between those two methodologies was as much as 15 to 20 basis points. Now that has returned to more normal levels, and it's only 2 or 3 basis points. So hot topic because it's theoretical and maybe interesting to a lot of people, but actually it is quite small now, the difference between methodologies. The last couple of points I was going to mention on differences is one is around calculating the rate. I guess the key point here is that unlike Libor, we've all had the luxury of just being able to look at a screen rate and use that, and we all know where we stand. For SONIA, there is no screen rate. As Ian mentioned, there is hope that index rates will be available, but those index rates may or may not be applicable depending on the actual conventions that are decided in the market. So that brings us back to a rate that is calculated manually. You will find if you look at any documentation, there is potentially, depending on your background, a quite complicated looking algebraic formula. Essentially, it's there just to sort of define how compounding works. But it's definitely something worth having a good conversation with your lenders who can explain exactly how that works and probably give you some spreadsheets to help you look at some real number examples. And then lastly, break costs. That's one of the conventions that changes very much as you go from a Libor term rate into a risk-free rate. We do not expect break costs to be a standard feature of risk-free rates, albeit conventions still to be discussed. We certainly haven't seen break costs in the early loan products that use risk-free rates. But what I would say is that voluntary prepayments are typically having a limit on the amount of those that are available in a given period of time. So last couple of points, I'm sort of conscious of time, but documentation, it's absolutely called out as one of the challenges to transition. There has actually been some really good progress there. The LMA have available on their website exposure drafts for both SONIA and SOFRA. They're also working very much to produce a multi-currency document that will include both risk-free rates as well as term rates, such as Euribor, which is not ceasing. So that's in work in progress. And then secondly, they're working on a switching mechanic document. So Ian's referenced that, a loan that starts on Libor but has an automatic switch to a risk-free rating. And that's a way to move proactively off risk-free rates, off Libor in the short term, but lock in the conventions and the mechanics so that there's no further transition needed. On that last point, it's really helpful to call out the actions that BAT have taken with their landmark syndicated deal in March of this year. That document is actually available on the LMA website, and it is a great sort of source of insight for anyone who wants to really understand some of the technical nuances that arrive as we move from Libor to risk-free rates. And that links me onto the activity in the loan markets. There's been more happening than is aware. Loan markets are a private market that inhibits some of the publication of activity, but certainly there was more activity happening behind the scenes. We certainly know at Lloyd's that conversations are ramping up quite significantly with borrowers. So plenty happening there. If you go onto the LMA website, they've also recently published a list of deals that have been publicly announced to the market. And they prove that we have done SONIA deals, SOFRA deals, even ESTA deals, both risk-free rates on day one, as well as that switching mechanic type of loan product. That's it from me, James. Back to you.
Great. Thank you, Phil, for clarifying some of the product choices around alternative risk-free reference rates. And actually, I was really glad that you brought out also that the perhaps slightly more mundane-sounding legal documentation actually can be quite a stumbling block in the process. So the importance of treasurers involving not only their systems people, IT people, but also their legal departments in tackling the Libor transition. We have a lot of questions flooding in, and I suspect too many to answer, but please keep the questions coming, because any that we can't cover or answer today, then we will make sure that we either answer as the ACT or feed into the relevant risk-free rates working group committees to try to get common answers published for the benefit of everyone going through this process. But before I bring in Sean to give the Treasurer perspective, this seems a good point to ask the audience how confident you are all feeling about your own Libor transition right now. So we have another poll question, again anonymous. It asks, how are you confident of completing your company's transition from Libor to alternative reference rates before 31st of December 2021? So please pick one of the 4 possible responses there. And just while the audience are choosing their response, if I can, Phil, just say some of the questions coming in, just one of them in particular, the COVID-19 support schemes, such as Coronavirus Business Interruption Loan Scheme, or CBILS in the UK, have referenced Libor as the interest rate for quite a few loans. Do you envisage any problems converting these outstanding loans to alternative reference rates by the 2021 deadline?
Yes, it's a good question. So I think lenders have taken a variety of options as to kind of the benchmarks used for those schemes. So clearly, obviously, some are using Libor. As I understand, those loans also have different tenors. Obviously, some of them are quite short. So where they mature before the end of 2021, then there's clearly no requirement to transition those, albeit obviously the risks of being linked to Libor remain. Outside of that, I don't personally, from the knowledge I have, see any additional complexities from those products versus other Libor loan products. What I would say is just to make sure that people understand what are in their contractual fallbacks in case that product cannot transition, but also as early as possible work with your lenders to talk about when they can help support you transitioning. There is more progress maybe in the background in some of the banks than maybe is aware. So I would recommend bringing that conversation up as early as you can.
Good advice there, Phil. Thank you. So turning to the poll results, and what we can see here is that currently it's 29% are confident of achieving the Libor transition. Perhaps not surprisingly, the largest response is for the second category, people who think that they will have converted all of their new contracts, but are perhaps struggling for some of their legacy contracts. And I'm conscious that legacy contracts might include wider commercial uses of Libor and not just financial contracts with the banks. And we've still got quite a sizable number of people down at the bottom who are not so confident of achieving the 2021 deadline. So turning now to Sean. Sean, as a group treasurer, can I ask you first whether these polling results resonate with you?
Yes, they do, James. I mean, I'm probably not surprised that some people feel they might not get there. I'm not sure I will get to the end of 2021 having perhaps transitioned all of my outstanding Libor instruments and will be relying somewhat on fallbacks or the ISDA mechanisms where they're applicable. But I hope to get there, and I'm certainly pretty engaged. And yeah, even for me, it seems there's not a lot of time left. There's quite a lot to do, but we'll see how we go. And I guess I maybe touching on my experiences from the last 6 to 9 months. I thought perhaps we'd be further on than we are now in this process, in this transition, in particular in loan markets and conventions. I think have been sort of a real challenge that we've gone round in circles a bit. We at ABP we've done a couple of loans in the last 9 months or so that have involved SONIA. We did a bilateral SONIA deal back in December where we used the lag methodology. We did a more recent loan with a group of banks that was on a Liable basis with a fixed mechanism to transition to SONIA in 12 months, but on an observational shift basis. Most of our swaps and bonds that we've done so far have been on a lag, so slightly different versions of the SONIA compounded methodology, and they do arrive at different, you do get slightly different answers, but they're all based on the same underlying concept that you're compounding SONIA, but there are some subtle differences, and I think, like Ian mentioned, hopefully those will be, for the loan market, a standard set of conventions will be agreed on for how we compound, and that will help people going forward, because in the conversations I have with banks and a range of banks, from your UK clearers to banks from all over the world with their own challenges around transition, and at very different places in their thinking and their process, and some banks perhaps not really much further on than many treasurers, which makes looking at sort of syndicated deals or club deals a bit more challenging as you're sort of trying to move everyone in that direction. My preference would be to do SONIA loans from day one, but that doesn't seem to be the case. But we have some very fixed timescales, and Ian mentioned as well that will apply to people doing loans, in the UK, and so there's a lot of work to do, I think, for some banks in the next few months to make sure we get there. So loans,
Sean,
I think.
Sorry,
yeah.
Sorry, Sean, for interrupting. It's just I'm conscious both you and Ian have referred to the observation shifts and lags, which are terms clearly being talked about a lot by certainly the larger companies and those involved in the risk-free working rate groups. I suspect there might be some people on the call who've possibly not heard of these concepts before. Can you just briefly explain why a lag is helpful when you've got a backward-looking rate like SONIA as opposed to a forward-looking rate like Libor?
Yeah, so I think for a lot of us, in terms of processes and systems and that, getting a rate at 9 o'clock in the morning and then having to settle the same day causes some challenges, certainly in the bond market where the lag first started, where you have a paying agent, calculation agent process. It's quite difficult to turn that around in a short space of time. So the lag enables, a 5-day lag or a 5-day observational shift allows you to know the rate 5 days before the end of the interest period. So you're looking at rates that start 5 days before your interest period and finish 5 days before the end. So you don't get a perfect alignment in terms of your daily rate that applies to your interest period, but it's very close. It's still easy to hedge in the swap market as well. But it just gives you that time, from our perspective, and that's preferable to do that. There are some then subtle differences around the number of days when you're compounding those rates, which is the difference between the observational shift and the lag. Probably the words are slightly misleading, but ultimately you've got a rate 5 days before you need to settle, and I think for a lot of us that's probably helpful. Same day would be more of a struggle, but I think the other thing then to touch on in the swaps market. And talking about swap fallbacks and swaps, we've done quite a few swaps now on a SONIA basis. Trading them is fine. The realities of settling them has been a lot more difficult, and I think we've had 18 months of settlements now on a SONIA basis, and we still continue to have issues with banks around calculations, getting rates 5 days before we have to settle. It's not going smoothly, and there's still questions around calculations. There's no set language in ISDA for doing lags and shifts as well, so that poses some problems. But perhaps as the loan market moves towards a standard, that will help drive the swaps market. So, swaps are there to their purpose, believe it or not, is to hedge. They are derivatives of the underlying, cash market. And when I talk to ISDA, they say, well, we want to see what cash markets want to do, and we'll make sure that ISDA language, enables people to hedge that. And because we haven't quite got standards yet, there isn't a market standard for doing lags and shifts in especially for corporates within that swap market. Sorry, I'll probably talk too much, and it'd be good to get onto some of their questions. But the other thing in swaps as well around fallbacks is it's very much focused on the clear market. So there is no concept of lags or shifts within the ISDA fallbacks as well. There is a shift in the interest period dates within the fallback to reflect the way the cleared swap market works in terms of settlement, but don't expect the ISDA fallbacks to be, solve all your problems necessarily, because you might still then get a difference with your underlying cash market. So there's still a lot of work to be done there from a corporate perspective. And ISDA's focus is probably, making sure that the vast majority of swaps, which are not in the corporate space, are dealt with and have a robust fallback from a financial stability perspective. So I think just a note of warning for corporates that there's going to be more to do on swaps as well.
So Sean, you've very helpfully talked about some of the external relationships that Associated British Ports has with financial counterparties, whether it's swaps markets, loans, bonds. Could you also say something about your commercial uses of Libor that perhaps don't involve the banks? And in particular, some of the questions that have come in are about what if I have an intercompany loan? So if I'm a multinational, I've got an intragroup loan. It currently references Libor. What do I have to do about that?
Yeah, those will need to be looked at as well by a lot of people. We've been through the commercial contracts that we issue. We don't have Libor referenced in terms of late payment fees, those sorts of things, or late payment costs. So we haven't come across it there. We do have some intercompany loans as well, but we're a UK only company, so we don't have any cross-border issues. But it does throw up questions around tax and stuff as well. So we are going to have to address those intercompany loans. Perhaps a bit easier when you're able to at least control the dialogue. But those all need to be looked at from a corporate treasury perspective. So it's I think it would probably be sensible to follow the standards that the market in general adopt. But we'll have to see.
And do you have problems where, for example, you are hedging an underlying commercial transaction and perhaps the swaps market has moved on, but you've now got a mismatch between your new hedge and the underlying commercial activity?
Yeah, in terms of our transition, we've been trying to transition swaps and loans at the same time to manage that hedging. It's been quite challenging because we're reliant on other third parties and where they are in their own thoughts around transition. So it's an ongoing issue. The last thing we want to do is start to introduce basis risk between SONIA and Libor. The spreads are more stable, but then we have seen, as mentioned earlier, the last few months that things can change very quickly, unexpectedly, when people thought there was going to be perhaps quite a bit of stability in those spreads through towards the end of 2021.
And I think it's great, Sean, that you also brought out there could be fiscal implications here, particularly where perhaps you've got an intragroup loan between two different countries, a subsidiary and company A borrowing from a head office or corporate treasury centre in country B. And where there's perhaps a step change, or maybe the authorities at one end or other don't like the new alternative reference rate. So that will need clarifying. And indeed, you talked quite a bit about hedging, so people need to watch out for any hedge accounting implications there. Now, all of this must be posing quite a challenge for your systems, and not surprisingly, there's quite a few questions coming in about are your systems able to handle the new rates and conventions? So where are you on systems? Are the systems providers ready yet, or are they still waiting for the conventions to be agreed?
Our system provider is ready, mostly. As conventions perhaps change, we might need to do some additional work. So, we focused on doing a 5-day lag. If we move to an observational shift, that throws up slightly different implications for the systems. I think the big change for us was moving for the system provider was going to a compounded rate and looking backwards and the impacts it had on things like accruals and some of the accounting implications which they need to reconfigure their system. So I think that was the biggest change. Some of the other changes are hopefully not so significant, but I think many systems providers just want to know exactly what's the direction of travel. And that's not just for treasury management systems, that's for, I guess, anyone on the lending side, banks as well. Because it is difficult to try and accommodate for too many different options, although perhaps that might be needed. I wait to see.
So, Sean, thank you. I'm very conscious that we're up to the 45-minute mark for the core content of this, but we do have so many questions, as I said. So I think there's a lot of potential here for us to follow up with a number of articles where, for example, ACT newsletters, where we'll try to tackle some of the questions that come in and that we haven't yet been able to cover. But Sean, in order to sort of cover a number of those in perhaps one go on some of the practical aspects, for those treasurers who perhaps answered in the bottom categories on our graph, who are perhaps not as far down the track as you are at Associated British Ports, what would be your sort of top tips for what should they be doing perhaps right now or in the next month?
I would start with some conversations with your bank group. I think that's a priority. Understand where they are. I would familiarise yourselves with Sonia if you haven't done already, and the formulas. And I would probably go as far as is understanding the differences between shifts and lags, and stay very close to what comes out in the next few months in terms of conventions, and just make sure you're on top of where your existing products are and where you have Libor.
Thank you, Sean. That's all great sort of practical advice. So as I said, there are a lot of questions. I would like to put one theme, which I'd like to put to Ian, which he briefly touched on, is international alignment, especially for US dollar and pound sterling reference rates. It is clearly a big concern for many treasurers. And possibly this is referring to the fact that yesterday the US Alternative Risk Rate Committee published recommended fallback language for syndicated loans currently using US dollar Libor, and many multinationals will use US dollar Libor. So, Ian, can you just elaborate a little bit more, please, on international alignment in the IBOR transition efforts, particularly with regard to the USA and the UK?
Sure. So if you think about the starting point, in the UK, the alternative reference rate that we chose to replace Libor was SONIA. That was chosen in 2017, but SONIA has been around in the derivatives market for 20 years already. So there's already a good infrastructure supporting it in derivatives. But we're building from a knowledge base that we have already, and it's just using that rate in different products. What you have in the US is they've created a whole new rate that didn't exist before. So the challenges to adoption were created to start with. What we're seeing at the moment is SONIA derivative volumes are roughly about 50% of Libor volumes today, so they're kind of broadly equal. Maybe that SONIA is more used at the front end of the market, but it's growing and the liquidity is growing in the derivatives market. You haven't seen that broad adoption of SOFR in the US market. It's still dominated by Libor, and where the conversations are more complicated is in the loan market over the use of conventions for compounded SOFR or possibly even simple SOFR. But there also seems to be a different view in the US, where I do expect the UK to broadly adopt a single version of daily compounded SONIA. There seems to be a number of different sectors of the US market. So you may see multiple rates replacing Libor in the US, of which SOFR is one. So it's a more complicated conversation to the extent if you get the international market, so those syndicated multi-currency loans, that's where we want to have the alignment. So if you are going to take a loan that can be drawn in dollars and can be drawn in sterling, then we try and get the interest conventions aligned for that end of the market. There may be differences in the lower end of the market in future.
Yeah, thank you very much, Ian. And Phil, very briefly, because we're pushed for time, I'm afraid. I can tell from the questions that I think there's a sort of undercurrent here of treasurers who are perhaps, looking afresh at Libor transition, can see this is all, going to be quite complex, and perhaps are still hanging on to the recent announcements about a possible synthetic Libor rate for tough legacy, and also the promise of some kind of term rate to be produced, and perhaps are hoping that somehow the problem goes away or the banks will sort things out for them. And I know the message from the authorities is very clear, that people need to be actively transitioning across to alternative reference rates and should not be relying on these solutions. But can you just, Phil, please, clarify the messages around a synthetic rate for tough legacy and a term rate?
Yeah, so on the synthetic rate, I mean, that conversation has kind of come out into the public in the last few days, which, given how long it takes the market to debate things like 5-day lag or shift, which has been months and months and months and months, it's so early in the formation of how that might appear. But again, I think the key message is don't rely on anything like that for your legacy contracts. Avoid them becoming tough legacy. Talk to your counterparties as early as possible and work out what's possible and over what sort of timelines. In terms of term SONIA, it's not going to be usable within the next 6 months. So that means if you are expecting it, you're having to wait, which just reduces your time. I would, again, start looking at the alternatives to term SONIA, understand what the differences are in your mind between term SONIA and a compounded SONIA. And if those differences are really untenable, then it might be something you have to wait for. But, the clear recommendation is that the market can learn to use a compounded SONIA, and having early conversations about it and understanding SONIA, I think, can help demystify some of the challenges that maybe otherwise make it feel a bigger step into the unknown than actually maybe it is in reality.
Thank you. So I'm afraid at that point, I think we've got enough material here that we could have kept going quite easily for another hour or so, but we have actually run out of time. So I'd like to just briefly, before wrapping up and thanking our speakers, just try to summarize. The Libor transition deadline of end 2021 sounds like it will likely affect all businesses. It's real, it's happening. And as we heard from the Lloyd's speakers, new conventions and products are being developed to facilitate the transition. We heard from Sean how corporate treasurers need an action plan. They shouldn't be relying on legislators or banks to fix the problem for them. And that in the short term, we've heard treasurers need to be remobilizing their Libor transition teams, including their colleagues in legal and IT. And Sean's advice was to get a comprehensive inventory of your company's legacy exposures to Libor, including the wider commercial uses, which also included the intra-group loans that we talked about. New contracts should have suitable fallback language embedded, and the survey result, the poll result, indicated that most people are confident of achieving that. And the advice from everyone was that treasurers should be talking with their banks and system providers to ensure that they can meet the interim deadline of Q1 2021 for transitioning all lending products. So as I said, we've reached the end of our time. We hope you found this session informative, and thank you to all of those of you who contributed questions. We've tried to cover as much ground as possible. I apologize if we didn't get to your particular question, but as I said, we will be actively following up on these. Please, can we ask you, do take the time to fill in the survey after the session ends, because the feedback you provide is very helpful to us when arranging future events. And on that note, coming soon, we have from 13th to 16th of July, the ACT's online Festival of Treasury Transformation, and this includes a keynote speech by the Archbishop of Canterbury, a former treasurer. And the festival is free to attend and is open to non-members who can register via the ACT website. So we hope to see many of you there for that. And finally, on behalf of the audience, I would like to thank Lloyds Bank and our excellent panel of speakers, Sean Kennedy from Associated British Ports, together with Ian Fox and Phil Harvey from Lloyds Bank. This has been James Winterton for the ACT. Thank you and goodbye.